Hello everybody, welcome to the A to Z of Property Investing Seminar, where we're going to go through and teach you how you can profit from property. So my name's Beryl Colley, and I'd like to congratulate you on taking the first step on what might be a journey to help build a more sustainable future. So just a little bit about myself. I'm the director and owner of Bricks and Mortgages, a member of PAA, and also I am a registered financial advisor. I am a property investor and a property investor in my own right, with my husband David, and also a property investor educator. So I've been in that field probably for about 10 years, always being passionate about two key things: giving my clients the understanding around their loan structures so that they know how to structure their debt more effectively and be debt-free faster, paying less interest to the banks, but also showing my clients how to leverage off their equity with minimal risk and using property as a strategy. So I'm really passionate about helping other people achieve their financial goals and helping them see growth. Okay, so tonight in this webinar we'll cover why property is a vehicle of choice for many. We're going to look at different ways how property can pay us money. We're going to learn how through planning and debt reduction strategies property can pay you money for life and retirement. Understand some smart money thinking for your own loan. Learn a little bit about what lenders are doing for investors, how to get finance, and some rules for the rich that can get you started on understanding some strategies. Remember, all this information is generalised, and what we can follow through with you is a personalised one-on-one consult, which will personalise your own personal situation, your own financial goals into a strategy. One of the things that I want you to understand is that investing is not a one-size-fits-all package, as everyone will have different goals, different financial starting points, different levels of risk, and different time frames to achieve financial goals. So I believe everybody's plan and strategy is unique. So everybody has different goals in life, and I'd just like you to think a little bit about sometimes we have crossroads in our life and we can carry on doing what we're doing and we'll get the same results, or we can take a different path and providing that different path and the decisions in that path will take you closer to your goal, then it's a path that's going to work well for you. So just some mindsets about the rich and the poor. If we're sitting on the poor side of the spectrum, life is often easy and we're content when it's easier. We're content to stay where we are. We exist rather than evolve. We blame others rather than take responsibility. And we procrastinate or don't take action, as opposed to on the rich side where we're taking action. It can be a little bit harder for a period of time. And on the rich side, there's short-term pain for a long-term gain. So the best decisions in your life take you closer to your goals. What's the difference between a rich person and a poor person? One of the things that I really believe in, and I've put a lot of time and money and effort into our own personal education as adults, is education and action. But the thing to understand about education and action is one without the other is useless. So intellectual knowledge without action is useless, but action without the knowledge is directionless. And certainly in property investing, action without the knowledge can cost you a lot of money. Tonight we're going to give you the education, or some of education, but it will be useless if you don't put it into action. In fact, what we're doing tonight is giving you an overview. It certainly wouldn't be enough education to set you on the market, into the marketplace as brand new property investors. But 66% of New Zealanders fear running out of money. 1 in 5 New Zealanders run out of money before payday, and there's they're actually 9-year-old statistics there. It's probably even higher than that. And there's many New Zealanders that probably wouldn't survive a 3-month period if they lost their job through health or a job restructure. So one of the things I want you to do is take the information and put it into action. Take notes as you go. Write down questions as you go, and if there's things that you want to address in a personal consultation, you've got those questions written down. So where will you be at retirement? And these are stats that are common across Australia and New Zealand. So if we take a snapshot of 100 New Zealanders at the age of 65, 24 will be dead, 54 will be on pension or welfare, 16 will still be working, 5 will be financially independent, and 1 will be financially secure and wealthy. So hopefully by the very fact that you're listening to this webinar, you've made a decision that you want to be in either the 5 or the 1 spectrum. So let's go through some information so that you can learn how to beat the odds. Getting rich is easy. The problem is most people don't know how. There are only 3 main vehicles for people to get rich: using a business as a model, investing in the share market, and then investing in property. So why are we concentrating on property? Property is a smart investment. There's a number of reasons that I'm going to go through that make property a favour for many people to invest in, and also a favour for banks to lend on. It's low risk and secure, and because of that reason, banks are happy to lend quite high lending on residential property. You can reduce your personal taxation, often as low as zero, often down to 0%. That doesn't always happen with the other 2 strategies. You can experience capital growth with property, and New Zealand has, even outside the global financial crisis, has a long historical record of capital growth over time. And I'll talk to you about property cycles later on. Leverage. Banks will allow you to leverage property, so you don't necessarily have to buy property with cash. You can buy property with equity, and you can't necessarily do that with shares, and with business you have to have more equity to put in to purchase a business than you would a property. Banks, as I mentioned, love property. It gives them security and something that they can treat as an asset. Property can be positive cash flow, and I'll talk to you later as to what positive cash flow actually means, but you can build a property portfolio that can pay you money so long as you've got continuing rent coming in. Property in New Zealand will continue to grow in value because we've got continuous inflation to some level. Population growth, increasing congestion, and driving up values in the inner cities. And there's always a demand in New Zealand for lifestyle and seaside property. The population is growing by 30 to 40,000 people per annum, and that's 10,000 new houses needed each year to keep up with the growth. In fact, in Auckland, if we look at what they needed to keep up with the growth, it's probably 4 or 5 times that as an immediate need. So what will a great result look like in residential property investing? I personally believe debt-free appreciating assets paying us a passive income. And that's we don't get that immediately. It's something that we work and aim towards. So in order to do that, we need 2 key things. We need to buy and hold property and have the ability to pay down debt. So let's look at how we can do this. We need two key factors to consider in your plan: the effective use of market cycles and gains in property, and effective debt reduction systems, so working those 2 things together. It's really important to understand the bank rules, effective finance under our rules, and using the bank systems. So let's look at some basic examples of finance strategies. What mortgage do you want? So with an investment property, assuming you've got debt on your own home still, in most cases we would structure the mortgage as interest only, because we always want to pay down your non-tax deductible debt first. No one gets rich paying off principal interest loans, and we're all told to get a job, yet we're all told to get a job and pay off your mortgage. One of the things that I do think is really essential as a financial goal is to set yourself on a path where you are actively down paying your mortgage, perhaps faster than the bank would have you do that, and most New Zealanders can do that. But for investment property, we would pay your mortgage at interest only until you were debt free on your own property, and then I totally believe in having a debt reduction strategy on your interest property once you're freehold on your own property. So what are the advantages of interest-only mortgages? It maximises your positive cash flow, reduces your risk when unexpected costs arise, and what would those unexpected costs might be? It might be a vacancy for a tenant, and you've got in between tenants some time gaps when you've got no income coming in. It might be some unexpected repairs and maintenance that you hadn't budgeted or planned for. But it also provides you with, if your loan is structured right, with the option of lump sum payments off your principal. You're able to use the extra cash that you accumulate to renovate or buy more property. And it also gives you maximum tax deductibility. Interest is tax deductible, but the principal is not when you are doing your accounting at the end of the year. It also increases your debt service ratio, because the banks will look at what your affordability is based on your current mortgage payments. Some mortgage banks offer a 10-year interest only period for your loans. Let's consider another option though. Freehold your investment properties before retirement, and the outcome is passive income in retirement. Let's see how that would pan out, and if this is a real client example. This was a $400,000 investment property with a $40,000 cash deposit. In this case, the client was freehold on their own home. And you'll see I've used a 7% average interest rate in this chart. So the total household income was $80,000 for this couple, and they had standard living expenses. They had a rental mortgage, as I said, of $360,000, but they had rent per week coming in at $430,000. So doing a budget for these clients are actually 10 years from retirement, so they had a choice of staying as they are and knowing that their outcome in retirement was the little KiwiSaver that they had and superannuation, or embarking on a debt reduction strategy on an investment property. Now, using their surplus income and the rent, they're actually able to freehold their investment property in 9 years and 1 month. So the outcome, now you have a property giving you a passive income, and now you can work out how many times you can do this to replace your income. Doing this also frees up equity and creates cash flow to grow a portfolio. And a thing to add on there, also saves you interest over time by paying off your mortgage faster with the bank. So who are we? Just as a bit of background, Bricks and Mortgages is all about connecting our clients with their financial possibilities, showing you how to reduce your loan smarter, and we've developed close working relationships with key lenders. Principal and interest loans. So most people understand principal and interest loans as homeowners. Where do most of your mortgage payments go? So if we just have a look at this, and I haven't updated it for 30-year loans, which is what the banks are offering most people now. But if you have a look here, it's not until after 10 years that you're actually making much dent in your mortgage anyway. And on average, people move house every 5 years and add time to their mortgage. So the loan structures that we work with allow you the flexibility to make far more serious payments to your mortgage in the early stages of your loan if you are looking to down pay your debt. So from that, let's just look at your home mortgage. And again, this is a very common example of what I see when we compile the information from our client consults. So this is a $339,000 mortgage, or close to $340,000. I've used an interest rate of 6.5%, and based on this client's budget and their expenses and their income, they could freehold their property in not 25 years, this is their owner-occupied property, but 12 years. Now, the interest savings for this is quite significant. It's $207,000, which is quite massive. So understanding this, your discounted interest rates and really affordable interest rates are important, but the thing I want you to understand is your mortgage cost is not just interest, but it's interest plus time. And if we can show you how to peel back the time, that's where your massive savings are. So just have a think about how could savings like this benefit you. This is a scenario, a true client couple. They were aged 50 and 56. They had a mortgage of $340,000, income of $51,000 and $58,000. In fact, their graph just before. Their old loan that we would have looked at would have taken them until 75 and 81 to be repaid. Under their new structure, their loan is expected to be cleared in 11 to 12 years' time, with a potential interest saving of $201,000. So every transaction that we make with our money when we're passing it across from ourselves to somebody else, whether it's a bank or a retail outfit, is we're choosing to pass our money from our economy to somebody else. So what I want clients to understand is learn ways to choose to invest in your own economy and not pass money over to somebody else's economy unless it's needful. So that's a massive amount of interest savings. So just to back that up, this is some information from the Consumers Institute website on a $350,000 loan, two people earning $60,000 each. And this is an example of 6 different loan structures and the potential interest cost for 6 different loan structures. Now you'll see there's at least 3 loan structures there where the interest costs are below $300,000. But the typical loan that most people embark on and pay on is $545,000. So there's a huge interest difference. So a big difference to your life if you're able to save that money, manage your mortgage in a different way rather than hand that money across to the bank. So the benefits of managing mortgage in a different way are improved cash flow at a time in life that it could serve you well, reduced interest costs, frees up equity faster if you do want to use it for investing, because every time we slice off a bite-sized chunk of your mortgage, it's creating equity. But even more important, hit retirement with less debt. Our advice, though, is different mortgage strategies will suit different households. We look at your options, not just the 6 that we've considered, and see how well they fit with your lifestyle. Your overall aim, which should be always to be more effective in reducing your own home loan. Different people have different operating surplus and different risk structures. But here's another little one: $200 a month each, extra month off the mortgage, which is $50 a week, save $77,000 worth of interest, and you're able to be freehold 5 years quicker. And again, this was an actual client. $77,000 is a lot to keep in your back pocket. As an investor, I think it's really important to understand your financial profile. When lenders lend money, they look at two key things: equity and debt servicing. So it's important to understand your financial profile and your strengths and weaknesses so that you work with them and not against them. Most people at one time or another will have one or other of these as what I call a brick wall. So if equity is your brick wall, then it's really important that we focus on buying a property with a discount or buying something you can add value to. If debt servicing is your weak point, then we even more need to focus on buying properties with good rental yields and decreasing your own debt so that we can push those brick walls away. A big danger is that you get a pre-approval from a bank and you buy off the pre-approval figure without understanding your goals and your financial profile. And that, if you buy the wrong property, can be the very action that stops you in your tracks. So going to the bank or the broker, be prepared. If you're going to the bank, know your figures. Banks will lend up to 90% on an investment property, but understand that if you're going to a broker, we work independently from the banks. We know all the banks' different lending guidelines. We're able to negotiate discounted interest rates, but we're able to sit independently from the bank to help you structure your lending in a way that minimises your risk against your own home and helps you understand how to minimise your risk with rising interest rates, but also structure your loans so that you can be debt-free faster as well. Bank policies. A really important thing to understand is as you grow your portfolio, it's important to understand that different banks will apply different rules to your loan to value ratio. A broker will always understand what these policies are. So why should you use a mortgage broker? As I said, it's independent expert advice. We don't charge you a fee. Maintain focus allows you to maintain your focus on investment opportunities. We have long-standing relationships with major banks and non-bank lenders. We understand investing and debt reduction strategies, and we are independent from the banks. Make property your passion. If you do decide to use property as a vehicle to invest for your future, make property your passion. Build your knowledge. Understand that successful investors are created, not born. So there is some learning and some effort that you will need to put in. But that'll be easier if you surround yourself with the best people that are also working in the same direction with your goals. And from my own experience, I really encourage you to get a mentor. We used a mentor in our early days of investing and found that a very valuable process. So I'm just going to talk a little bit about the property cycle. I'm not going to predict where we are in the property cycle because everybody on this webinar will have their own opinion and view. But the important thing to understand is the market is cyclical. Just as the interest rates go up and down, the property market goes up and down, but over time it constantly goes up. So what properties were 10 years ago is totally different to what properties are worth now. The important thing is with property, though, is to have a goal to recycle your deposit with a 6 to 12 month period after your purchase. So how do we do that? We want to pay wholesale, learn to buy below market value. Look for opportunities when you're buying property to renovate and add value to the building. Develop. There are opportunities where you can add additional units if the land allows you or the council plans allow you. Subdivide, add additional lots. And capital growth, learn how to buy in high capital growth areas. So use any of these factors or a combination of these factors along with debt reduction to add a minimum of 20% value so that you can release your equity for the next deal. So how the rich borrow to make money. Some key points here. Only borrow to buy income producing assets. So what would be assets that aren't income producing? A vehicle or a holiday. People will often put on their mortgage or on their credit card. They're not income producing assets. So save up for those. Only borrow high capital growth or high cash flow property. This way you will balance growth and equity with debt servicing ability and never run out of borrowing power. And always look to recycle your deposit as I just explained. Learn how to create equity over time. The number one rule of the rich with property is to make your money buying right. So it's really important when you go through your initial negotiating phase with your property that you get that first transaction right. Buy at a discount, or if you are buying at market value, you're doing so knowing that there's an opportunity in the property where you can add value. Investing is personal. Everybody's goals are different. So know your goals, your financial goals. What are you aiming for? What dollar value do you want in retirement, and how long do you want to take to get there? Know your buying rules, know your local market, and know how to negotiate. But really important is be able to walk away. The number two rule of the rich with property is to only build a positive cash flow property portfolio. So some people in the marketplace would say only build positive cash flow, only buy positive cash flow property. If you make your rule too narrow and defined, some people will never get on the board with property. So build a property cash flow portfolio. And that may mean you have some properties in high capital growth areas where they may be supported by properties in different areas. And so your whole portfolio is positive cash flow. So if we have a look at what do we mean with positive cash flow, it's basically where you've got more income coming in after expenses. So just an example here, rental income minus your mortgage interest minus rates, insurance, repairs and property management gives pre-tax cash flow of, in this case, $3,180. So a very rich man once said to me, I would rather have 50 shacks paying me good money each week than have 3 palaces that cost me a fortune. And that's Brad Sugars, who's a well-known self-made millionaire who owns the international franchise of Action International. But I'll tell you my thoughts on this. Although he's right in what he says, because most people couldn't afford 3 palaces that cost them a fortune, you'll often find that if you have cheaper properties in smaller towns, your net return is not as good as if you had properties in bigger cities, because the ratio of your rates and insurance compared to your purchase price is a lot higher, and your tenant demand may be a lot lower, and the smaller towns where the cheaper properties are, and what may look initially as higher rent yields may be supported by one main industry, and you're very vulnerable if that industry reduces or diminishes. Negative cash flow will keep you poor. Negative cash flow property will keep you poor. So negative cash flow property is property that requires you to keep feeding it money because the rent doesn't cover the costs. So I'm just going to talk you through some lies told about negative cash flow property. So it gives tax savings. Can you think of many occasions where you'd spend $1 to save 33 cents? And giving tax savings, it is really important that your property portfolio is structured so that it's tax effective. Another myth or a lie is positive cash flow property doesn't exist. I'll give you some examples towards the end of the presentation where I've had clients find really good positive cash flow property. Positive cash flow property get no growth. And again, the examples that I'll show you are in good Wellington CBD, Wellington fringe suburbs, and I've got clients in Auckland where there is growth, where they are getting good positive cash flow property. It's a compulsory savings plan. Again, if you refer back to the first point, it isn't a compulsory savings plan, because if you work out over time the money that you put into negative cash flow property compared to the population growth doesn't necessarily get you ahead in the market. Negative cash flow property purchased in low growth areas will keep you poor, especially if you have limited income. And this is where understanding your financial profile is really important, because if you buy the one negative cash flow property, it can hinder your borrowing power if you're not on a huge income. So how do the rich people achieve more financially in life than others? So just some things for you to think about. If there's a faster way of doing something, do you think they've found it? They certainly have. How do you decide which property to buy? How do you decide how much you should pay? What the returns will be? And what will the impact on this property have on the success of future purchases? One of the things that I say to clients is think about building your property portfolio as you would as if you were playing a chess game. Most chess players would map out their next move before they complete their first move. So when I sit down with clients that I'm working with, before we make the first move or complete the first move or finalise the decision on that, we have an understanding on how that impacts on our ability to make our next move. So the important thing is we understand leverage with property, but we've got to understand how to leverage our time to get the best deals fast. The number 3 rule of the rich with property is never ever buy on emotion. The figures are all that count. One of the things that I think is really important is use tools to assist with analysis, and I've got an example of a tool here that can very quickly, when you populate the figures, show you whether the property is negative cash flow, positive cash flow, or what dollar amount a week the top up or cash flow is. The number 4 rule of the rich with property is to build a good team of experts around you. So don't do it the Kiwi DIY way. Build a strong team for the right advice. And some examples of team members I've got here are mortgage broker, accountant, lawyer, property manager, property mentor, and real estate agents. And all of those need to be specialists in what they're doing, not generalists. So make sure you use the right lawyer, the right accountant, or even a real estate agent that understands property investing. You are only as good as your team. The most expensive advice you can ever get is free advice from a poor person. Fire anyone on your team that is not an expert in the field of property investing, does not meet deadlines, has misrepresented themselves or failed to deliver, is ethically unquestionable, gives you bad advice that loses you money, offers a sales pitch rather than investment education. Ask, how much did I learn about investing? And remember, if you're the smartest person on your team, then your team is in trouble. Choose to be around smart people. Find a superb accountant and solicitor, one that understands and supports your goals and directions. Remember, price is relative to results. The better your investment education, the better the investment advice you will receive. The rich are generalists. They do not know everything about everything, and they do not want to. They draw on the advice of experts, so they do not have to become one. The number 5 rule of the rich with property is set up the right tax structure. And the number 6 rule of the rich with property is decide on your investing rules before you begin. So I referred to investing rules before. It will help you, if you decide on your investing rules, help you narrow down the marketplace and spend less time searching and eliminating properties if you understand your investing rules. Those rules will cover, plus much more than this, location, yield, type of tenant, cladding, discount, and add value potential. So I'm just going to talk through building cash flow and capital growth properties. So high capital growth, you want to buy below market value. You want to buy in designated capital growth areas. You want to use depreciation to minimise after-tax losses. And for high cash flow, you still want to buy below market value. It must be positive after-tax cash flow, and it can be in any area. So we want to... I've got a slide later on just to give you an example on combining those two types of properties. In this property pyramid here. So don't get so hung up on the numbers, but just understand that the green triangle represents your high capital growth property, which might be giving you more growth but costing you a little bit in money. And then you've got 3 positive cash flow properties that are supporting the cash flow for your high capital growth area. So it's building a balanced portfolio. So how do we find the hot deals? We look in newspapers or we look in words in advertising like urgent, desperate, heavily reduced, well below valuation, transferring overseas, vendor has already bought. And remember, there's always lots of deals that aren't advertised because they've been on the market for months and agents have lost interest in them. They no longer want to spend money advertising. Build relationships with real estate agents and follow up after auctions or tenders to see if properties have sold. The number 7 rule of the rich with property is to keep building a positive cash flow portfolio until your passive income reaches the goal you require. And remember, right back in the beginning of the presentation, it's really important to understand what you're trying to achieve with property, what time frame and what dollar value of cash flow are you wanting to achieve. Set some goals so that you know what you're aiming for. Are you focusing on equity growth or cash flow or both? How will you achieve your cash flow goal? How long does it need to last? And how long do you have to get to needing it? How much can you put towards your retirement? So if we had a look at this graph here, we've got the upward circle, which is your working life. And then we've got a period of time in retirement. So for most of us, we need to allow for funding our income for 25 years in retirement. Then we've got superannuation and KiwiSaver that'll fund into that. But what we're trying to do with property investing is give you a strategy so that you've got another income stream coming in retirement. Now again, property cycle. Warren Buffett says the crowd is not always right, but the crowd is always late. It's often a really good idea to do things counter-cyclical to what the crowd is always doing. So it's not always good to buy when the market is all hyped up and in the height of the market you're competing with a lot of buyers. Look at opportunities when the market is slower, there's less buyers in the market and vendors are more distressed. So providing the property meets your buying criteria and gets you closer to your goals, any time is a fine time to buy a property. So identifying cash flow. What's on our side for cash flow? Low interest rates, higher tenancy rates and increased rent return. So let's have a think as to why we might have higher tenancy rates. Last year, the Reserve Bank in New Zealand implemented some changes which made it harder for first-home buyers to get into homes. So we have less first-home buyers and more people still renting. So if we have $350,000 loan now at 6.3%, the interest costs are $22,050. 6 or so years ago, we would have been paying 9.3%. That same $350,000 cost you $32,550 per annum. That's a difference of $10,500 or $202 a week that you don't have to find in rent returns. Add in $3,000 for rates and insurance, and now in today's dollars it's $481 per week in rent to cover costs, as opposed to $684 per week a few years ago, and perhaps in a few years' time. So I just want to talk to you a little bit about new versus old investment property, and I've got an actual client example here as well. A new property will generally be more tax effective due to higher value of chattels, will generally attract more stable tenants, have lower ongoing maintenance, and generally attract higher capital growth. So here's the actual numbers for a new property. It was a brand new property purchased at $320,000, produced a rent of $420 a week, rates $2,500, insurance $1,000, and 100% loan at 5.9%. 2 weeks vacancy, we budgeted into these figures, and an 8% property management fee. So an after-tax cash flow to the investor for this property is negative $33. So it's not positive cash flow, but it's negative, but we need to understand that there's lower maintenance that the client needs to budget for over time. So if we just see how that looks on a pie graph, who pays for the cost of an investment property using this example? The tenant funds 85%, the tax savings fund 8%, and the top-up in this case equates to 7%. So in any property we want to make sure that that top-up is as small as possible, or not at all. So financial consult, just want to talk to you about if you're a homeowner or a property investor, we'd like to offer a strategy consult. So we can look at your loan structures? Are you paying off your mortgage effectively? Have you got financial goals that you're working towards? Or if you're an existing investor, an optimization review, looking at your existing portfolio and working through what could you do going forward. Okay, so just before we finish off, I've got some actual client examples and some tips that we can go through. So where possible, avoid cross-securitization with your home, your property, investment and business. So a broker is best to help you there. Banks will want to minimize their risk by taking as much security and equity as possible. So one thing that a broker can do is help you have and build a multi-lender relationship. Always focus on down paying non-tax deductible debt first. So when you've got your own home mortgage and your investment mortgage, we'll pay down your own home mortgage first. Think carefully when adding depreciable consumables to your home loan, whether that's a car or a holiday or consolidating debt. If you do need to do that, don't do it over a 25 or a 30-year term, but do it over a much shorter term. Work with a system that builds in some disciplines. Many people that I see don't have any system in place to understand what their budget is or whether their spending is in line with their budget. But so work with a system that builds in some disciplines, but always make sure they're spending money for you in your spending plan. Tip 2, minimise your exposure to rising interest rates. Do not have all your mortgage on one fixed term. A broker can give you good advice around that. So where can I help? We're able to assist with first home buyers, restructuring loans to have a smart loan to save interest, investment purchases, short-term funding or property investing mentoring. So here I've got some client examples of properties, and you'll see that there's a number of these properties that are positive cash flow. A purchase price of $562,500, weekly rent of $940. Positive cash flow, this property was $80 a week positive cash flow. It was fully renovated property to a high standard inside and outside, and this was in a good Wellington fringe suburb. Here's another one, purchase price $558,000. This property had a weekly rent of $1,100 per week. It was positive cash flow by $196 per week, and again these figures are assuming maintenance, some maintenance budgeted, 2 weeks vacancy and property management. This was an old villa in good condition, 5 minutes from the university in Wellington, and is the sort of property that could rent year in, year out very easily. Another example, $565,000 purchase, $870 weekly rent, positive cash flow $50 a week. This was 3 flats in a top Wellington suburb, and they were low maintenance. And just to show you that it can work at the other end of the scale, you don't have to necessarily be in the position to buy at those price levels. Purchase price $187,000, weekly rent $235 per week. This was a renovated property with low maintenance, and it was self-funding. So this is a disclaimer that you'll be able to read through, but as I said right at the beginning of the slides, the information that I've gone through is general and generic. It doesn't apply to anybody's specific situation. So I do encourage any one of you, if you want to take the next step, would be to contact us for a consult, and that's a free service that we provide, where we get your information and provide this feedback to you on a very personal basis based on your own financial goals, your own income and your own time frames. So balancing capital growth, cash flow and capital growth, as I mentioned before, just to recap. Capital growth, we want high capital growth areas, buy below market value, buy in a designated capital growth area. Positive cash flow, we want to again buy in a buy below market value, and buy properties that are giving you an after-tax cash flow, pre-tax and after-tax cash flow. Why is capital growth important? If you purchase a property for $400,000, after 10 years it would be worth. Now these are just some scenarios. If we look at 3% capital growth year on year, it'll be worth $537,566. 5% capital growth year on year, $651,557. 10% capital growth year on year, $1,037,000. How do we buy lots of high capital growth properties without running out of borrowing power and taking big financial risks? And that's a key thing that you need to ask yourself when you're learning to understand your financial profile and building your strategy. So do you want to fast track your success with property investing? Do you want to understand the game? Do you want to know the rules? Do you want to play to win? Do you want to learn how to play properly? Do you want to learn proven strategies? Do you want to play on a winning team? And will you do whatever it takes for your success? Just want to talk you through a mentoring program that we do. It starts with a 6-month program. Runs through with continual mentoring, education and coaching in property investing. We apply up-to-date, tried and tested wealth accumulation strategies that work in today's market. Work through with you on a personalised investment plan. This mentoring is one-on-one, not a group mentoring model. So the benefits of mentoring. By participating in the mentoring program, you'll be able to accelerate your wealth creation using a personal investment action plan. Analyse investment opportunities with confidence and accuracy. Seek immediate advice from your property mentor and make sound decisions based on your working knowledge of effective investing strategies. It's a 12-month mentoring program consisting of key components: personal consultation, tools and resources, and unlimited phone and email support. So know the rules. Have knowledge, preparation, planning and results. To invest without knowing the rules, without a plan or guidance, is simply to speculate and gamble with your future. Personal consultations overviews. Your initial consultation is 1 to 2 hours, more to the 2-hour time. We perform an investor audit and health check. Establish your purchase power. Review your structures. Propose initial buying rules and set goals and a foundation from which the year will develop. Establish an initial action plan. Consultations 2 to 4. Review your strategies, rules and progress. Address any challenges. Set your next steps in the action plans. Review your specific deals and build your motivation. Consultations 4 to 6. Review strategies, rules and progress. Set action plans for the coming years. Review your achievements and review any immediate challenges and opportunities. And in the big picture, this is just the beginning. Unlimited phone and email support. Now this is really important. You can ask the big or the small questions and seek timely expert advice. Example, to clauses to include in sale and purchase agreements, dealing with real estate agents and property managers and others, due diligence consideration for various properties, reviewing your personal investing reviews. It's really important to work with a coach that understands your financial position, your goals, and the initial plan to get you there. Key points we discuss in the mentoring. Your due diligence. What is it? What questions do you ask? Who do you get the information from? Cash flow analysis. How to analyse the cash flow viability of property. And we have a tool to supply to assist you with this. Creating your buying rules. This will help bring clarity so that you are more focused on what you are looking for. Building your team of experts around you. Learning how to negotiate and build relationships with real estate agents. And becoming an expert in your chosen market. So finally, if success is important and you'd like to support, please book a free no obligation consult to make sure that this is right for you. Below you'll find our phone number, and that's an hour consultation, and you'll find that you'll get, regardless of what you do, you'll get some really good information around your own personal finances and what you can do going forward for your future. Again, as I said in the beginning, I congratulate you on taking this first step of what would be a really exciting journey for you to start building your financial future and security for you and your family. And remember to take people on that journey that are happy to support you through that process and the right experts on your team. I wish you well on your future and look forward to meeting you face to face. Thank you. Bye.